Did you guys know that more bear markets ended in October than any other month? Did you also know that October was the month of stock market crashes? Yes, it is the most bipolar month in all of the stock market. And the fact that this year is a midterm election year makes the stats even more important because it introduces a whole new host of stats. So we're going to get into all this, why the stock market is mooning on the first trading day of October. Luckily, we bought energy stocks and semiconductors on the dip. There are some opportunities which are too good to pass up right now. You know what? Let's just get right into it. So as I said, October is known as the bear market killer. Since World War II, 12 bear markets have ended in October. 46, 57, 60, 62, 66, 74, 87, 90, 98, 2001, 2002, and 2011. Here's an additional crazy stat. This year is a midterm election year. We have the elections coming up November 8th. Do I care who wins? Not really. 7 of these years were midterm bottoms, meaning that 7 of the 12 bear markets ended in October during a midterm year. Here's something else that's amazing. October also has been the month where historic crashes, historic one-day crashes that we've seen have happened, right? We had 1907, 29, Black Monday, which everybody who's over 40 remembers, 1987. Well, I don't really remember it like that, but I do remember my dad standing in front of the TV freaking out. So there you go. And here's something even more interesting as it pertains to midterm years, that when we have a bad performance or a down performance in the stock market from January to September, as we have now, which is the worst start of the year since I think 2002 or something like that, certainly one of the worst on record, there's only almost a 50-50 chance that October through December's performance will also be down. In a midterm election year, since 1926, the S&P 500 has been up 80% of the time with a median return of 5.6% from October to December. Now let's take a look at the chart of the SPY and see why this is important. We hit the psychological level of the 200-week moving average, the green line here. This is usually where on corrections and some bear markets, we end up bouncing from. Even in the worst crash that we've seen of the last 10, 12 years, the COVID crash of 2020, we ended up going to the 300-week moving average, the red line. However, at the 200-week moving average, we ended up bouncing one of the biggest reversal days in history. It was March 10th, 2020. From the bottom of that day's candle until the top was a 9% day. So the reason that we are bouncing here on the first day of October makes a lot of sense. This is a very psychological level. Now, I'm not saying this is the bear market bottom. As a matter of fact, when looking to accumulate quality blue chip stocks, looking for the bottom is futile. You want to buy things when they are considered cheap. And right now, in my opinion, there are a good few buys. We bought SOXL, which is the semiconductor ETF. This thing was at a high of almost $75, currently trading at just under $10. This currently holds stocks such as Nvidia, Qualcomm, Texas Instruments, Broadcom, Intel, AMD, Marvell, etc. And if you follow me on Twitter and Instagram, which you should because I do produce daily finance content on those two platforms, as well as on YouTube, you'll know that we bought XLE at this major support level as well. This is the S&P 500 energy sector. This was down over 22% since we bought it, but the reason that I bought this was twofold. One, they produce a 4.4% dividend, or at least they did at the time. The dividend yield was 4.4% at those prices. I also tracked the oil markets from a geopolitical framework, and I knew that OPEC was not going to go down without a fight. They were enjoying the high gas prices too much, and gas prices came down significantly. So lo and behold, this came out yesterday. This article comes out yesterday that OPEC Plus is going to consider cutting oil by over 1 million barrels a day. As you know, they are a huge cartel. They control all of the oil supply in the world, or most of it, right? And also, what's going on in Russia and Ukraine is not helping. So there's already a constricted supply of oil. And now the cartel is trying to force prices to go higher by cutting production. You also have the possibility of China reopening after zero COVID lockdowns are lifted, whether that's at the end of this year or next year. The fact that we got a 4.4% yield, dividend yield on XLE, which was better than any treasury that you can buy at the moment, well, I was thinking about it like this. Sure, treasury yields are getting somewhat attractive, especially the short-term yields. So if I'm looking for some yield, would I rather buy a fixed asset like a treasury that's doing nothing except for giving me 4 point something percent of my money? Or do I buy XLE that gave me a 4.4 dividend yield, but also I get a chance to make some money from the equity if OPEC starts messing around, cutting production, if the price of energy continues to go up? Well, I chose the latter because regardless of what happens to XLE, the price point at which we bought it gives us a 4.4% dividend yield. We also bought options on Occidental Petroleum, which, as you know, is Warren Buffett's darling. Shout out to the analysts on the Discord. We alerted all of our buys in the Academy. We are also up almost 20% on this cash secure put that we sold on the SPY, the 320 cash secure put. Now, before I get into what I think has to happen for October and why all of these $1 million bearish orders are coming in, 1.3 million, 1.1 million, 1.8 million, 8.3 million, all of these are puts. We're going to get into this, but before I do, we just opened up spots for October. So if you guys are interested in my analysis, in our plays, what plays we're making on options, futures, stocks, long-term holds, cash secure puts, covered calls. We just closed our Apple and Tesla covered calls for 90%. Our day trades, if you want access to the courses, the day trading course, the options course, you want access to the Zoom call. We just wrapped up a 2-hour Zoom call over the weekend. You get access to all of this if you apply to join the Academy. We just opened up application spots, so book a free call with one of our ambassadors. Link is in the description below. Let's talk about these bearish puts that are being opened by the millions of dollars. So, as we talked about, October is a wishy-washy month historically. October has ended more bear markets than any other month in history, especially during midterm elections. October is also the month with the most violent crashes in history. So which way are we going to break in October and for the rest of the year? Honestly, it depends. I do think that once the midterm elections are over, that might set the stage for a little rally, as we always see after midterm elections are over. However, remember this. We have CPI coming in October 13th. We have the unemployment rate coming out end of this week, October 7th. Those two things are really going to drive what's going to happen in the short term for the market. So remember when the jobless numbers came out and we hit a 5-month low on the jobless claims. This was actually not good news. In terms of on the ground, this is great news because we don't want people to be unemployed. As it relates to the stock market, this is not good news because this means that the Fed will have to keep hammering with Fed rate hikes until they can actually start getting a crack at inflation and making sure that the unemployment rate goes up. Yes, the Fed does have the devilish mandate of needing to raise unemployment in order to curb inflation. That is just a matter of fact. I hate that that's the case, but that is a matter of fact. Now, the unemployment numbers come out October 7th. If they are lower than expected, then I think the market will lose steam and continue to tank once again. Furthermore, October 13th, which we will do a live stream, so make sure to tune in. If inflation comes in higher than expected, that is also likely going to tank the markets. If one of these two things happen, that is likely going to tank the markets. More so if both of them happen, if unemployment comes in lower and if CPI comes in higher. We are getting a little bit of reprieve in the market as the British Prime Minister finally gave in and said, okay, the tax cuts that I had planned for were actually a pretty dumb idea. We're not going to do this anymore, which is why the US dollar index is heavily down today. And when the dollar index goes down, that is good for stocks, which is helping to boost stocks today, and also lower bond yields, which is also good for stocks. All that because the British pound actually went up on this news. So when the British pound went up, it is one of the major currencies that is tied to this relative index that compares the US dollar to a basket of currencies, one of them being the British pound. So when the UK finally said, okay, we're not going to do these tax cuts, the British pound went up, driving the DXY down, also driving bond yields down. Now, also remember that November 2nd, we have the FOMC meeting. And right now, it's a toss-up what they're going to do. And I think it largely depends on the unemployment October 7th and the CPI October 13th. If both of those things come out unfavorable, the Fed will have to come through with another 75 rate hike, at least a 50, but most likely a 75 rate hike. And that is not going to be good for the market because that is going to be the fourth time that they raise rates by 75 basis points or by at least 50 basis points. Actually, will be the fifth time that if they do a 50, it will be the fifth time in a row they raise rates by at least 50 because they did 25, 50, 75, 75, 75. And then if they do 50 or 75, that'll be the fifth time that they raise rates by at least 50 basis points, which is super aggressive. They have not yet given the economy time to see how it processes these rate hikes. But as you know, I am on record as saying that I do think we eventually get to the pre-COVID highs, which is around 3,300 and change on the S&P 500. On the SPY would be around, 340 level. And I think we get there because just logically, if all of these tailwinds here were Fed driven and were COVID driven, and now both of those things don't exist anymore, we haven't even talked about earnings compression yet, right? Like we haven't seen what these rate hikes are going to do to company earnings, and we have earnings season coming out October, November. So that for me is the last shoe to drop. That earnings guidance is lowered and that company earnings are being heavily affected by the rate hike environment. Then I think that is the last shoe to drop. And we might even get below the pre-COVID highs. But psychologically, I think this level right here is going to be one that the entire market, institutions and retail alike, are going to be looking at. And it's not out of the realm of possibility to hit that 300-week moving average on the S&P 500. So whether we have a mini rally or not is really neither here nor there. The only reason that I would want a mini rally here is that if I am targeting the pre-COVID highs as a short level, it is much more optimal to short from a retracement than to try to short from this level here where puts are already expensive. So I am hoping for a mini rally to get back to a technical level to be able to short from, because I'm not saying I want the market to tank. I just think we're going to get to this level at least. So if I think that, then I would much rather have an optimal short than a non-optimal short and go back in the market once again. Anyway, hopefully you got something out of this video. Again, October being the most bipolar month for stocks, right? Not only has it been the bear market killer, which I don't think this bear market is going to be done until the Fed stops hiking. However, we could see a mini rally depending on CPI and unemployment. But also it is the month that has seen the most violent crashes in stock market history, which because of the level to which we crashed already, I don't think, barring any sort of black swan event, I don't think that's going to happen either. But whether we get a rally or not, again, depends on those things that I talked about. Leave a comment down below. Let me know what you think. We open up spots for October. So if you want access to all of our courses, the Zoom calls, the plays, the analysis, the chat with thousands of traders, so you don't have to trade alone, link is in the description below. Book a free call. The call is free. Talk to one of our ambassadors. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Stay safe out there, traders. Peace.